Fortunately for us, the firm wouldn't do cannabis lending because they weren't comfortable. They had LPs that weren't, very into the idea. And obviously it was early stage and they were leveraged by the bank. So the bank was shut out from the space. So at that point, one of our founders saw the opportunity, decided to leave, and then got together with a couple partners and launched our first fund. Fund one was a senior secured, direct lending fund focused on the cannabis industry. Here, I was launched in September of 2019. We did $130 million in loans across 20 credit facilities. Of those loans, they were all senior secured, fully real estate conforming. That fund generated a 19% net return for 2020, and then did 21.54% net for 2021. In May of last year, we were approached by an investment bank that liked the portfolio and wanted to take it public. So that fund IPO'd and is listed on the NASDAQ, trading under the ticker REFI, R-E-F-I. Subsequently to that, we launched our second fund. The main difference is it has an offshore feeder blocker component. So onshore investors using self-directed IRAs and foundations, as well as offshore investors can come in and be capital and tax efficient by eliminating UBIT and ECI. This fund's targeting $500 million. It was launched in May of 2020. We've raised a little over $280 million to date. Over the last 10 months, we're raising between $8 and $10 million a week and deploying it even quicker. This is an evergreen vehicle. It's a 2 and 20 structure with an 8% preferred return. There's a high water mark at a 2-year lockup. This is an income generating vehicle that'll pay 2.75% quarterly distributions. So you should look at it as an income generating vehicle as well. The most important thing about this vehicle is you come in immediately diversified as an investor. So currently there are 28 active loans. 8 of those loans have an equity picker component where we have the ability to purchase a percentage of that company at a specific strike if there is an acquisition or they announce that they're going public. The vehicle is completely unlevered, delivering high teen returns, obviously, on all senior loans. The majority of our investors are, small or middle market RIAs, a lot of family offices, and then obviously ultra high net worth investors. Of the 44 loans we've done to date, it's a little over $1.2 billion in total credit facilities. We've had 0 defaults. Comes down to very robust underwriting, very strong financial covenants, and obviously the very robust collateral packages we're able to obtain. That's where we are today. A typical loan has an all asset lien, UCC1, mortgage or deed of trust on the property. We get a stock pledge of the license holder. So the subsidiary that owns the license is pledging their stock interest to us. About 60% of the portfolio is fully personally guaranteed. So we could sue the guarantor at the same time as the borrower if there's an uncured default scenario. And, I would say our average LTV in the space is below 60% when just looking at licenses and real estate collateral. But what's important to understand is you do have your enterprise value. So if we look at loan to E to V or the enterprise to the company, we're typically under 15. We're lending at very low rates. And we have a pipeline of about $928 million in loans that we're actively looking at. About 260 are already under terms. So right now the fund's in a position to continue underwriting deals that fit best in the portfolio and continue to grow. So I mentioned we're raising $500 million here, about $8 to $10 million we've been raising a week. And we're on track to take this thing to $500 million by hopefully the end of the year. It's a little overview on us. If anyone wants to dive in with questions, I'm happy to answer, or we can jump into what a standard deal looks like in the space.
Is there like a geography or specific areas? Like we've always heard that places like Oregon have too much cannabis. Other areas you look at in particular, or?
Yeah, a great question, Marty. And one thing that makes us different from other lenders in the space is we only target what are low license states. Low license states tend to be on the East Coast, east of the Mississippi, where oligopolies exist. And the reason these oligopolies exist is because the state issues only a very limited license component. So a state like Pennsylvania, 25 grow process licenses, 50 dispensary licenses, 11 cultivations are only online right now. That license on a discounted transferable value is still worth over $60 million. So that's an important piece of our collateral, to only go after low license states. We haven't done a deal in California. I'm not saying there aren't good deals in California, but the opportunity for us really exists in these limited license states. So that's where we focus.
Sector, distributors, producers, retailers.
The majority of our operators are vertically integrated. So they have cultivations, and then they also have dispensaries where they obviously sell the flowers.
With those you underwrite the deal. Oh, sorry, I'm sorry.
With those kinds of yields, are you finding increasing competition? Absolutely. Those are attractive.
Yeah, no, absolutely. There's definitely competition in the space. We're the largest by about a multiple of 2.5. The fund itself, there's other credit funds, smaller funds that will buy into some of the widely syndicated loans. Our biggest difference is obviously we're one of few that only focuses on limited license states. but also direct originations. That's how we stay on the forefront of these deals. We have a team of 8 direct originators that are, down state by state, staying current with borrowers that are coming close to terms. Hey, you want to buy something, you want to build something new. And then obviously as new states issue new licenses, we are one of the only few that can write $100 million checks. So we are typically the first stop shop for a lot of borrowers.
And how do you base the underwriting? Is that based on credit worthiness of the individual, the business, the opportunity?
Yeah, so the first thing we'll look at is where they're located. As I mentioned, limited license states are very, attractive compared to a state like California, Oregon, or Washington. So depending on the state, the majority of our capital is used for CapEx and M&A. So as we lend, our collateral packages tend to increase there as well. So typical underwriting, I mentioned there's a mortgage or deed of trust on the property if there's real estate. We get all asset UCC1 liens on the outgoes. We take stock pledges of the subs that own the license. We perfect our position on the license. And then the majority of the portfolio is still personally guaranteed. Now, the typical loan from financial covenants, because I think covenants are very important to have in place, obviously, because you can see, any tabling event before there's real deterioration in value. So typical loan has a minimal cash coverage covenant, which is my favorite. It's about 10 to 20% of the loan balance in a bank account that's tested perpetually in nature. And we have a deposit account control agreement on. We also require fixed charge coverage ratios, typically 1.5 to 2 to 1, tested on a trailing 6-month basis. And then for some of our newer operators, we require monthly reporting instead of quarterly, and that's the majority of the deals.
Yeah, my big concern is, let's say you're lending, and now New York City has some kind of a stricture where they've said we're only going to give licenses for distribution to people who are former felons.
Okay.
How do you write that loan?
Yeah, I mean, it comes down to really vetting the borrower. The average borrower in the space, the due diligence deposits typically $250,000, $500,000 before we actually start to underwrite the loan. So, vetting the borrowers, can't say everyone with, felony background might be the worst operator in the world, right? But I think the majority of people in New York where they're issuing licenses are for misdemeanors or charges if you have cannabis or possession of cannabis. So it's the do right for the injustice. But we've vet all of our borrowers, background checks, references, and everything as well.
Is there a question on the cannabis market? What % of cannabis is distributed retail versus mail? Or is there any mail distribution?
So there's no mail, there's no interstate commerce. So you can ship a pound of flour, say, from California to a state like Pennsylvania. So I think interstate commerce is maybe 10 to 20 years away.
But how about intrastate?
Intrastate from shipping,
yeah.
Typically you have to go to a dispensary, so they're cash only.
No matter what. Gotcha.
Yeah, you can't really ship to that extent.
They're popping up all over New Jersey. I mean,
really?
Just went to one the other day, and I can't find what I bought, so that's a problem. But it doesn't mean the stuff is that good. But yeah, so we see a lot of it, and I'm sure we'll see more and more. So it's good to see. I mean, I'm sure in you guys' business, you're always tracking the regulations. As I work with Canadian companies on this, somewhere on the intellectual property patent side, where there's still a lot of research and development around it, and lots of companies doing that from Israel to Canada and all around the world. But every company is tracking what's going on with the feds. So what do you guys see on that side? I mean, how many states have kind of approved at least the recreational, because you have the medical recreational side? How many?
So there's 16 current that are it's recreational adult use. Anyone over the age of 21 can walk into a dispensary and purchase for their own consumption.
Yeah.
More states come online. The big shift is once it's medical, you have different processes where it's medical for X, Y, and Z. The most widely distributed is chronic pain. Typically after chronic pain, the state will look to go rec, but the driver is neighboring states. So for example, if the state next door has now made it recreational, the states in the surrounding area made it's only medical, they'll jump the border and they'll go buy it in another state. These states are now losing out on tax revenue.
Sure.
So the shift is to ultimately get to recreational.
Yeah, when are the feds finally gonna say, hey, there's tax money there for us too? And because it's been the issue for so many years. I'm surprised it hasn't happened. Everything going on with gambling and everything else, it's like smoke pot where you gamble. That's the big deal.
No, absolutely. And we look at that as well, right? It's the SAFE Act is the largest driver where the banks will have safe harbor in the space and will be able to lend and bank cash of these operators. And it's now been passed by the House 8 times. It's been shut down in the Senate 7. If it will go through, it'll likely be this round. And we look at it as a net positive because we are senior secured lenders delivering high teen returns unlevered. So as banks enter the space, sure, they'll lend against the billion-dollar publicly traded MSOs. But they won't lend to the middle market borrowers, which is where we tend to focus. So they will likely lend to a fund like Chicago Atlantic than the underlying borrower themselves. So on a very conservative basis, we can keep returns using very conservative leverage, as well as more states will come online. You'll get rid of this tailwind risk of, enforcement or anything some people might think, as well as more CapEx and M&A, which is obviously the most, very, intensive. And
So if a family office calls me and says, what are you seeing? Where's a good investment? That sounds like you guys are a good investment. That's an easy question.
As long as someone's comfortable with cannabis, not everyone is, obviously, and that's why it exists, right? But I mentioned we raise between $8 and $10 million a week.
Wow.
This fund is grown pretty substantially, and mainly through word of mouth, through very strong family offices and networks like Marty's here. So
Do you, so you don't just finance cannabis products, but you do all the whole line of cannabinoids, like pain management pills and things like that, or do you have specific, again, vertical that you look at?
yeah, no, so everything starts with the cultivation and then ultimately ends up in a dispensary. So our cultivators are growing and harvesting flower. They could be extracting that flower and turning it into wax or cartridges or edibles, which then they're ultimately selling in dispensaries. So the whole sweep of every cannabis product is typically in the dispensary, and we finance the cultivation to the dispensary where it comes out of.
Don't doctors also distribute the products?
Doctors will write you a prescription to go to a dispensary and pick up what they
And where are you guys with CBD? Is that?
no CBD. We did a
Because
loan early on in CBD, but the opportunity exists in cannabis. I mean,
Yeah.
a lot of farmers turn their land into hemp and CBD farms. They overbuild supply. There's really a tough market there to exist.
Yeah, no, along the lines of production and distribution. So I think last week there was this article in the journal about the black market and how it's sort of killing the legal folks because of taxation, and they want to go clean, so to speak. But then the black market sort of takes a huge market share because they don't pay any taxes.
Absolutely.
So sort of how do you see that, and what are the numbers? I'm just curious. Like, is the black market 80% of the trade, or what does that look like?
Well, it's estimated that cannabis is between $120 billion industry. 23 billion of that is addressable in state-sanctioned legal markets. Now, the rest of that is the black and gray market where they're looking to move rec. And to that point, that's why we don't go after California, Oregon, or Washington. A lot of the black market stems from Northern California. There's a large variety of black market. It's the cheapest cost of wholesale flower. There's a lot of legal regulators that might be operating a little bit under the law. So we only focus on limited license states. We haven't done California, mainly for that reason. If we go to California tomorrow, you can ultimately get a license and then start cultivating. Where in Pennsylvania, as I mentioned earlier, there's 25 cultivation licenses and 50 dispensary licenses. That license is so valuable that you'll operate in the terms you're allowed to. You won't do anything under the sun, because on a discounted value, that license is still worth over $50 million. So the operators we lend to, they know the value of their license. It's farthest away from where the majority of the black market is. So that's why we like to focus there.
Great.
Do you want to take us through a case study of something that you've done?
Yeah, I mean,
Also how you target growth
Yeah.
opportunities, et cetera?
absolutely. And I'd say it's one of our largest loans. It is our largest loan and one of our favorites, a company called Verano Holdings. Verano is a $2.8 billion market cap company based out of Chicago. These guys are encumber about 16 states. They're probably top 5 in the world. Verano early on was, a company that was booming out of Chicago. Ultimately went public and they were looking for capital. So the first loan we did to them was a $30 million credit facility. That was then upsized to a $70 million credit facility. They use it for expansion into new markets. And then obviously that was upsized again to 120 million, which was upsized to 250 and to 350 million. Verano is one of the top companies in the world. This should be between a 3.5% and 4% loan in the traditional market. All in, they're about 11.5%. So we still see the top decile of operators that will be the ones to start getting the cheaper capital sooner. Still taking debt from us at a significantly higher rate than the traditional market.
11.5%. That's good.
And that's the lowest rate in the space.
And what is the where does competition fit in? Do most of your loan products go out to bid, or is it what's the process? Or and is your advantage speed?
Yeah, it's size and speed. So being the largest and doing some of the largest loans, we're on the forefront of seeing things almost first, as well as direct originations. they, really originate the deal before it even comes to us. So that's one of the largest. Now, competition, still the main form of competition is equity. Being that the cannabis equity markets are down, the demand for debt is higher. It's too expensive to raise equity. And that's really the driver of everything. It's not that these companies aren't performing. It's just this lack of any reform that's allowing, safe harbor for banks in the space or a federal legalization action. But yeah, equity financing, and then obviously you have sale leaseback models like IIPR. They'll buy the building, they'll give you whatever you need, they'll lock you in for a term for 15 to 20 years with no ability to refi, and that's the other option. But for us, we're just focused on senior secured delayed draw term loans where we will unlock tranches of the investment for and the debt for operators as they perform.
So you haven't made any equity investments yourself in Verano or anything? It's all been
Not
credit
personally.
facilities?
Everything's been credit now. The biggest driver for Fund 2, which is very attractive, is any loan that has an equity kicker or a warrant, where we have the ability to purchase the company or percentage of the company at a specific price or have penny warrants in the company. Can only go to Fund 2 because it violates our opinion letter with the NASDAQ for listing. So any deals that do have a small equity component go to Fund 2, which ultimately can attribute to significant value if the company exits or announces that they're going public. Now, currently that portfolio has 28 loans. 8 of those loans have an equity kicker. But as equity markets start to increase, I think we'll see those less and less, but they're still readily available.
And what is it, 3 or 5%? As far as the 3 or 5% equity kicker? I mean, a low amount of equity you would get?
Oh, well, so it's like they're typically in the form of cashless exercise warrants. So it's not actually equity. It's if we're in the money when they announce or we hit their strike price, we can purchase.
And what's
okay,
that percentage?
okay.
It's 23.5% of our loans have an equity kicker.
And what's the size of the equity kicker?
They vary. It's typically on the smaller end, nothing too substantial, maybe 1 or 3, 1 to 3% of the company.
Right. And I think that's pretty new in the space, isn't it?
Absolutely. I mean, it's a way for a borrower to
Be very
negotiate a
profitable.
little bit of a lesser
I think a
term.
lot of people wanted to kind of avoid, getting involved in the equity side over on the lending side, but maybe it's changed. It's a more friendly environment now.
Yeah, and it's something they'll say, hey, instead of 15% all in, let's do 14 and some penny warrants.
What about multi-state operators?
So Verano, as I mentioned earlier, they're in 16 states. I mean, they're a great multi-state operator. We like multi-state. I think 40 or 50% of the portfolio encumbers more than one state. It's great. I think I personally would prefer one operator to be the best operator in a single state than be a decent operator in 5 states, where you have Verano, who's one of the best operators in every state they encumber. So it's a bit different.
How is the loan secured across state lines?
Across state lines, it's through real estate. So the majority of our deals are fully backed by real estate. Now, the subsidiaries that own the licenses will pledge their stock interest to us in the specific state that they encumber. So if we're doing a loan, let's keep using Verano as the example. We're senior secured on all assets. They have assets and real estate across all 16 states that we're secured by.
I assume that each real estate asset is a separate company by itself, and Verano it's like a holding company.
Exactly. So they're all different subsidiaries that own the license. So each dispensary, each cultivation is owned by a subsidiary that owns that.
And they pay a
license.
rent to the holding company who owns the.
Typically, they own the real estate. The majority of operators do. There's some good ones that have very valuable licenses and might have a sale leaseback that we'll look to do. But the majority of what we do is fully backed by real estate.
You could send this, Connor? You have my card from last night.
Yeah. What are the rates again?
Our gross unlevered yield on Fund 2 is 16.7%, not giving into effect any equity kickers or warrants. The fund it was 19% for 2020, 21.54% for 2021, all net after fees. Distributes 2.75% quarterly. But the most important thing, and I think it's something a lot of people don't look at, is the diversification, which is so important. Our investors that come in today are immediately diversified across 28 deals and gaining exposure to the existing equity upside, because the equity upside is level 3 assets. They're held by private companies. They're the most illiquid form of any assets. We hold them at cost, and then as they appreciate, you increase NAV. So investors coming in today have the same exposure in a warrant that someone that came in day one had, just because of the way you have.
So it's an uncorrelated investment.
Absolutely. I mean, as the market goes down and then people turn to alcohol and tobacco, pharmaceuticals, they also look to cannabis. I mean, we saw a boom through COVID, and people could argue that you saw a boom because more people were home consuming it. But we also saw a boom, and no one was traveling and vacationing to hotspots where they would, maybe purchase it because they're on vacation or it's not legal where they're from. So we look at it as a fair valuation of the industry as a whole.
Yeah, really impressive.
Are you guys involved though on the operation side of it? any money to?
We won't take a board seat or anything per se. Now, we will advise if we have a company that says, I'm in Maryland, I want to get some exposure in Arizona. We have systems in place that have tracked every single transaction for a license in every state. So if they say we're going to buy this cultivation license for $20 million and we see the latest transferable value is much less, we would advise against it, as well as market dynamics. We don't just act as a capital provider. I think we're a strategic partner that really understands the industry. We have a team of 38 based in Chicago and a small office in Miami. And we have a very significant track record in cannabis. So we definitely can provide some sort of counsel, but we don't lend and take board seats and look to control the company whatsoever.
What kind of trends are you seeing just like through the supply chain from cultivation to dispensary? Are you seeing, and is there been any, I'm sure there's some costs to take out.
Absolutely.
So is that happening? I know it had started to, going from mom and pop to more mainstream.
Absolutely. And there was 3 trends. So I would say the first thing in cannabis was this land grab where it was licenses are coming out. We want the best place dispensary. We want the great place for a cultivation facility. Second was the license grab. Everyone's putting in for licenses, putting in bids to acquire new licenses. And the third part, to your point, which I think is the third or fourth inning of cannabis, is M&A, right? You have these large operators that are going to attack a state when it goes right because they want a footprint there. They'll acquire the licenses from operators that were lucky to win a license in a lottery or purchase a license at a low cost. And that's great for us because we have make-whole provisions of 24 months on all of our loans, and then we have prepayment penalties on all of those loans as well. So as people take us out, the fund, returns significant from that. So we like it. We lend to some of the largest, like Verano's and a couple other publicly traded companies, but then also some of the newer operators in the state that just got 2 licenses that are worth over $100 million and will likely be acquired. So
the average duration of your loans is 2 to 3 years?
1 to 3 years. The average duration is 28.5 months. So they're very short-term loans, which we use as a hedge against, federal reform, right? If cannabis became legal tomorrow, it would still take a pretty significant amount of time before banks would enter the space. But if from a state perspective, if, one state decided they wanted to issue new licenses, it takes 12 to 24 months for that to even get through legally. Then it takes 12 to 24 months to build a cultivation. Another 12 to 16 to grow enough flower to have any meaningful impact on wholesale prices. So that's why we structure them.
What's the fund term?
The fund term, as an investor, it's a 2-year lockup.
Okay.
It's a 2 and 20 structure, 8% prep with a 2-year lockup.
Right. And do you do like co-investments as well? Like
Yes.
SPVs?
So we have some families that really like the paper. So any investor over $5 million in the private fund gets access to co-invest. We use co-invest and we have LPs that love the paper that will take down significant chunks of co because we won't go over 10% of any loan in the book. So we have a loan like to a company like Verano, it's $350 million credit facility. You can only put maybe 20 in the REIT, 20 in the private fund before you mess up the diversification. So we tranche it out to, LPs that like it for discounted or no fee, no carry co-invest.
What percent of your lending is done to public equities versus private equities?
So the majority is private. We have about 7 or 8 deals that are to public companies of the 44 loans we've done. So the majority is private. But as we see the shift, more private companies will go public or be acquired by public companies.
Any other comments? Or this is really, fantastic news. And Andreas has talked to our group half a dozen times probably. So
I think last time he was here, we had maybe 50 million in loans, and now we've done over 1.2 billion. So it's phenomenal growth, and it's great seeing some familiar faces here. So.
Sure, we got to present in Miami and in California as well. So I think obviously California's got a great symbiosis when it comes to what he does. So,
Absolutely.
what you guys do. So fantastic.
Nice.
Any other questions?
Just one last one.
Yes.
How do you feel about infrastructure versus the plant in the marijuana space?
So in regards to real estate versus a farm, or
The technology behind growing it.
I think it continues to advances. We like hydroponic farms, right,
Yeah.
where you grow the best quality of flower. An outdoor grow, the majority of that's grown there can only be extracted, turned into vape cartridges or edibles. Where indoor grows in greenhouses, maybe hydroponically, that's the higher quality of flower.
Yeah.
About 45% of Americans still do prefer smokable flower, so it's important to have very high quality grows.
Thank you.
Fantastic.
Great.
Any other questions? Any closing thoughts?
No, if anyone's interested in looking into a vehicle that is very diversified, you get exposure to equity upside and a hedge against the traditional market, and experience cash